Operation Sindoor impact on markets. How equities reacted to URI strike, Balakot strike, Kargil war. The Indian stock market on Wednesday remained volatile, assessing the overall impact on the Operation Sindoor, in which Indian missiles struck terror infrastructure in Pakistan and Pakistan-occupied Kashmir (Pak) to retaliate last month's Pahalgam attack. The BSE Sensex was trading lower by 163 points at 80,448.39 in the morning trade as of 10:08 am, while the NSE Nifty declined 73 points to trade at 24,305. Among the 30 Sensex companies, 22 stocks were trading in red. The top losers were Asian Paints, Larsen & Toubro, HCL Tech, Sun Pharma, and Ultratech Cement, declining by up to 1.61 per cent. Hayraise how markets reacted to URI strike, Balakot strike, and Kargil war. As geopolitical tensions flared again between India and Pakistan, investors are turning to history for clues on how Indian stock markets typically respond to military and terror-related events. From the 1999 Kargil war to the Balakot airstrikes and the URI surgical strike, Indian equities have consistently demonstrated a striking pattern: initial jitters followed by resilience and recovery. Nananabhishek Jaiswal, fund manager at FinaVenue, said, historical data suggests that the Indian stock market has generally responded with resilience to serious geopolitical events. Except for the Parliament attack in 2001, all other incidents studied have led to positive market returns over the medium to long term. He added that it is important to recognize that the likelihood of a full-scale war remains low. As long as such escalation is avoided, India's economic growth trajectory is unlikely to face any major setbacks. In essence, while the initial reaction to cross-border strikes may be cautious, markets tend to recover and even thrive thereafter, reinforcing the idea that political stability, strategic decisiveness, and national security assurance are valued by investors. Balakot airstrikes markets absorbed the shock swiftly. On February 26, 2019, when the Indian Air Force conducted precision airstrikes in Balakot in retaliation for the Pulwama terror attack, the Sensex fell by 239 points and the Nifty lost 44 points. However, markets rebounded quickly. By the next trading session, indices had stabilized, a sign that investors viewed the operation as a measured, strategic action with limited long-term risk to economic fundamentals. Pulwama attack muted market reaction. Just days earlier, on February 14, 2019, the Pulwama terror attack had shaken the nation, but its market impact was surprisingly mild. The Sensex dipped a mere 0.2 the following day. Analysts attributed this to the lack of immediate retaliation and the anticipation that the government would respond in a calculated, rather than escalatory, manner. URI surgical strikes initial panic, then rebound. The market's response to the 2016 surgical strikes across the line of control, following the deadly URI terror attack, was more pronounced. On the day of the announcement, the Sensex dropped over 400 points, while the Nifty tumbled 156 points, reflecting sudden investor panic over the possibility of war escalation. But just days later, markets recovered, reinforcing the narrative that short-term fear often gives way to medium-term fundamentals. Kargil conflict, a surprising rally amid war. The 1999 Kargil war offers the most counterintuitive data point. Despite being a full-scale military conflict that lasted over 2 months, the markets surged. Between May and July 1999, the Sensex soared by 1,115 points, a rise of over 33, while the Nifty gained 319 points. The rally was driven by multiple factors, including domestic economic reforms, favorable monsoons, and political stability emerging after the conflict. Operation Sindoor. What factors may drive markets? V.K. Vijayakumar, chief investment strategist of Geojit Investments Limited, said, what stands out in Operation Sindoor from the market perspective is its focused and non-escalatory nature. We have to wait and watch how the enemy reacts to this precision strikes by India. The market is unlikely to be impacted by the retaliatory strike by India since that was known and discounted by the market. Swipe left for next video. The main catalyst of the market resilience in India is the sustained FII buying of the last 14 trading days, which has touched a cumulative figure of Rs 43,940 crores in the cash market. FIIs are focused on the global macros like weak dollar, slower growth in US and China in 2025, and India's potential outperformance in growth. This can keep the market resilient. However, investors have to watch the developments in the border, he added. The big shift in market preference in favor of large caps away from overvalued segments of mid and small caps is significant. FIIs, as always, are mainly buying large caps. This trend can continue, Vijayakumar said. Latest blogs.